This weekend, First Republic Bank was seized by U.S. regulators and has now been taken over by JPMorgan. This is the second largest bank fail in history and the fourth to fail in just 2 months, 3 of which have been American banks. So what's happening in the financial markets, and why is it causing all of these failures? In the past 2 months, 4 major international banks have failed. First, Silicon Valley Bank collapsed after a deposit run meant it could no longer support itself. SVB dominated the headlines earlier this year, as it was the largest bank fail since the 2008 financial crisis. Only 2 days later, Signature Bank also failed. On the 19th of March, UBS bought out Credit Suisse for $2 billion after the major Swiss bank collapsed. These failures happened in quick succession and caused major turmoil in the markets for several weeks. Each failure inspired a new deposit run for customers who no longer had trust in their bank. This is exactly what caused First Republic Bank to follow suit. Just like Silicon Valley Bank, First Republic is a mid-sized California-based lender with a specific client base, which in this case is wealthy individuals. This made it particularly exposed to the shockwaves of the recent banking turmoil. In Q1 alone, customers withdrew more than $100 billion in deposits, and the bank's share price plunged almost 75% last week alone. Unfortunately, U.S. regulators had no option but to close the bank. The U.S. Central Bank, the Federal Reserve, was forced to step in with emergency measures to stabilize the markets to prevent more funds being withdrawn amid growing fears of a new, wider banking crisis. However, finding a buyer for the remaining deposits isn't always easy. When Silicon Valley Bank closed in March, the U.S. government had to protect deposits up to the federal insurance cap of $250,000, which cost the FDIC's deposit insurance fund about $20 billion. Thankfully, JPMorgan, the biggest bank in the U.S., has said it will assume First Republic's $92 billion in deposits. JPMorgan has also agreed to acquire the substantial majority of their assets, including $173 billion in loans. Jamie Dimon, chairman and CEO of JPMorgan Chase, said, "Our government invited us and others to step up, and we did. Our financial strength, capabilities, and business model allowed us to develop a bid to execute the transaction in a way that minimizes costs to the deposit insurance fund." The failed bank's 84 offices in 8 states will reopen as branches of JPMorgan Chase Bank from Monday. This government broker deal is the latest in a series of bigger banks, swallowing the failing smaller banks at a discount. First Citizens collected the scraps of Silicon Valley Bank, New York Community Bank got hold of assets of Signature Bank, and UBS bought the remains of its rival Credit Suisse. JPMorgan Chase has once again stepped in to save the remains of a failing bank. It has provided reassurance to the international financial systems and to its new consumers. But above all else, it provides the company a discounted opportunity to acquire a bigger slice of the U.S. banking industry, making it a more powerful bank than ever. Just as I spoke about in a previous video, Morgan Stanley say the strong get stronger when it comes to banking. JPMorgan was also one of Morgan Stanley's top 3 stock picks for 2025, and you can see that they are already getting it right. If you haven't watched my previous video already, definitely go check it out, as it goes into detail about 3 long-term opportunities handpicked by Morgan Stanley. Thank you for watching to the end. Let me know in the comments your thoughts on the recent banking turmoil. Do you think there will be any more failures this year, or is 4 banks enough? Make sure you subscribe so you don't miss out on any investing news or opportunities.